Let's start, Jacob.
Oh, everybody in here?
Yeah.
Yeah.
Sweet. Great. All right. Yeah, time to get started. Thank you all for coming. First off, today we're doing a webinar for real estate investors, how to reap tax benefits from the OBBA, which is the One Big Beautiful Bill. Brought to you by both me, I'm the senior tax advisor here, Jacob Natovic, and Justine, the CEO and founder of Zhou Agency.
Hello, everyone.
So a little bit about us. I know a lot of you guys might be clients, but some of you might not be. So a little intro to what we are and what we do. We are a full service tax advisory firm with a focus on tax efficient wealth accumulation. We offer strategies and we can execute the strategies for you for tax savings. And our primary focus is dealing with real estate investors, high income earners, and small businesses all across the US.
Well put, Jacob.
Thank you. Thank you. Yeah, we've definitely worked on our positioning statement before. So, so today, while everybody's here, we're talking about the One Big Beautiful Bill updates and how it affects real estate investors. There are two major updates from the Big Beautiful Bill for real estate investors. One of them is opportunity zone investments. These start January 1st, 2027. And then the 100% bonus depreciation, which applies to any assets acquired after January 19th, 2025, or I should say any business assets.
Yeah, I'm going to chime in here a bit, Jacob. So the OBBBA has stirred up a lot of conversations, right? And it had quite a bit of changes. So Jacob did a good job here to just, highlight these two, which we think are the two most important changes for a real estate investor. And I believe we're going to go deep on these two topics. Yeah. So
yeah,
it's not like that's the only two. We know there are more.
Yeah, there's lots of updates and lots of effects. If you guys are current clients of ours, feel free to schedule with us if you want to go into the impacts of non-real estate related items, or if you're a new client or a new possible client and want to schedule some time with us, please feel free.
Yeah, we also did a webinar last year after the bill passed about all the details on the change, and I'm sure that we can post that link into our chat box. So if you're interested, you can check that out. That one has a more comprehensive explanation of all the changes. Yeah. But these two, you're right. And it's really good to put the starting date there, right? It's starting date different.
Yeah. So again, the opportunity zones are 2027. But then the bonus depreciation actually came into effect for any asset after January 19th of 2025.
Yeah. So we're in 2026. So go ahead and buy a piece of real estate, guys.
Yeah.
Or any other business assets. You're right, right?
Mm-hmm. Mm-hmm. All right, now let's get into opportunity zones. This isn't a new topic, I would say. In the first Tax Cuts and Jobs Act, there was a opportunity zone carve-out, and that ended in end of 2026 is that when tax?
Yeah, it should end the end of this year, but nobody's doing anything this year, right? Because you're not going to be able to defer. So the older rule is you can defer all the way until December 31st, 2026. But if you're selling assets today, there's no deferment, right?
Yeah. So this is the Opportunity Zone 2.0, I believe they call it.
Yeah. That's a cool one. Accountants are cool now.
Yeah, we got a cool lingo. But yeah, so with this new Opportunity Zone, it still has capital gains deferral. And it's for up to 5 years from the investment in the qualified opportunity fund.
Yeah, maybe you can explain to us a little bit what's an opportunity zone first, because maybe someone don't know, just simple language. No?
Oh, yeah.
Jacob?
Yeah, exactly. So opportunity zones, these are zones picked out by the government where they think that more investment would better the zones or the neighborhoods, whatever it may be.
Mm-hmm. Yeah, basically, it's a little bit challenging area that the government want more investment into the area. So they carved it out on the map and calling this opportunity zone and give you a lot of tax incentive to invest in these areas for it to become a better community, better neighborhoods, right? Mm-hmm.
And a lot of people might be asking, like, why would the government do this? It's losing them tax dollars. What's your opinion on why the government would do this?
Oh, we know that. The government is actually pretty smart. They write tax codes to incentivize you to do things they want you to do, right?
Yep.
So I mean, there's another joke we say the real estate is the best investment under the tax code. Why is that? Was the tax code written by real estate investors? No, still written by all the government officials. They just want you to invest in real estate in the long run because that's the backbone of any economy, right?
Yep.
Yeah, they're very
Exactly. So
smart.
they're giving you your reward for doing what they want is a nice
Yeah,
tax refund or deferral.
yeah, and it's not. I have clients say, "Oh, that's how about if I don't utilize it?" And I would say, "You're not very smart, right? You have to utilize these tools for yourself, and you are helping the country too because they want you to do this. Trust me, it's good for the country too."
Yep. So, all right, let's get back to the rules now. Um,
Uh-huh.
so, one big change from the old opportunity zones to the new ones. This is a 5-year period of capital gains deferral, where the other
Yeah,
ones.
it's a rolling, right? So it's always 5 years instead of just ending in 1 year. So it's also kind of permanent, right?
Yep, yep, and that's something a lot of my clients are excited about because a lot of people are having all their old opportunity zones kind of come due at the end of 2026. Where
That's a
this,
big bill to pay.
yeah, that's a big bill to pay in 1 year. Where this, if you do an investment in 2027, it won't be due until 30 or yeah 2032. Wow, that's crazy to
Yeah.
say. And 27 would be 33. So it's a nice rule here. So it's not one big tax hit at once. And then the second thing with the opportunity zones is the 10% step up in basis after 10 years, which is kind of a confusing concept, right, Justine?
Yeah, people call it a basis setup. That's like you can tell that's an accounting lingo, right? So in layman's language, basically, if you can wait for 5 years before you sell the new investment, you will also just basically forget about the 10% of your capital gain. So if you say your capital gain is 100,000, now it's deferred in 5 years and you only have to pay tax on the 90%, right?
Yep.
That's what it means. So basically, the 10% will be forgiven. And you should keep it for 5 years, anyways, right? Why not? Because
Mhm.
the new investment, you don't want to pay tax either, right? Let's
Yeah.
go on, Jacob. Yeah. Mhm.
Yeah. So it's called a basis step up, but it's more of like a step down kind of feel. You're like, a reduction in your capital gains is basically
Yeah,
what it comes out
reduction
to.
in capital gain. Very good. Mhm.
And that is just with a standard opportunity zone. These new opportunity zones as well opened up a 30% step up in basis for investments in qualified rural opportunity zones. So I do think the government's trying to get you to invest in, maybe a small town or something like that.
Mhm.
So that's there's even a 30% step up. So in that case, 100 grand deferred, you'd only have to pay tax on 70 grand of capital gains when they become due.
Yeah, that's pretty huge. And I'm sure a lot of people, developers and people are looking into projects in the rural area, which will be good for the economy. Mhm.
Yep. And then you get full exclusion on post investment appreciation. So Justine, what would you say that means?
So that just basically, like I said, you will definitely keep your investment for 5 years. Why not? Because if you keep it for 10 years, all the appreciation on this new investment will be forgiven tax wise. So give you an example. So let's use the 100,000, right? Jacob was really smart. On January 1st, 2027, invested in a rural opportunity zone. And then you sell it in 2037 on January the 2nd. So you kept it for 10 years, and that $100,000 investment become like 300,000, right? It's possible.
Yeah.
And then when you sell it, you only have to pay tax on 70,000. Oh no, I'm sorry. You only have to pay tax on the nothing. You actually have to pay tax nothing. The other $70,000 you have to pay tax at the end of 5 years, which is at 2032, right? Sorry, I messed up here a little bit.
Yeah.
So by the time you sell the investment, you made another $200,000. You don't have to pay any tax. And in the first $100,000, you defer for 5 years. And when it's time to pay, you only pay tax on the 70,000, not 100,000. right, Jacob?
Yep.
Now I'm correct. I covered my ground.
Yep, exactly. So, that's exciting. And then there's also a caveat if sold within 30 years. And I do believe that the rules are like, let's say, you sell after 31 years, only the appreciation on that 31st year would be taxable.
Yes, yes, yes. They give you 30 year of capital appreciation, right?
Yep.
Free of tax. Yeah,
Yep.
that's pretty awesome. Yeah. So I want to also say something here. So you just have to watch out how they carve out the zone. So people actually ask me this question quite a bit, Jacob, back in 2018. Does it mean that my investment will be at higher risk in the opportunity zone because it's an underdeveloped area? I would say, like any investment, you have to do your due diligence, right? Yeah, it doesn't mean it's because it's in the opportunity zone, it's a higher risk. You still have to do your own due diligence. And another thing is, if you are investing in other people's fund, you also need to check out those fund organizers.
Yeah.
Right. Yeah. So I personally don't think it's because it's opportunity zone, it's just worse. So you got to expand your horizon.
And especially with how this tax code is written, they're really trying to lock in, investments there for 10 plus years. So a lot of money is going to be pumped into these, less fortunate areas, I guess you could say. So, yeah, I wouldn't say it's overly risky, but also do your due diligence on that area, on the fund. New designations of these opportunity zones. So they're drawing the map. I think that comes out July 31st of this year. So that's when you can start looking into, possibly some of these investments. And then as of January 1st, 2027 is when you can start making the investments into these opportunity funds.
Yeah, so making sure that in July or August, look at the map in your state. And I guess what, Jacob, the governor has a lot of power.
Yeah.
And
yeah.
I'm sure there's something going on there too, right?
Yeah.
Which area goes into the Yeah, okay.
Yeah.
And there is no inside information right now, because if it's the map is going to come out July, you have time to do your research for your next project.
Yeah, give you a full 6 months for your next project. And there is a couple options for opportunity zones. You could want to invest into a qualified opportunity zone fund through like an investment advisor that normally requires you to be some sort of accredited investor, which for most of the people in this.
Yeah, most of our clients are.
Yeah, and super easy to hit. Or another option is to create your own opportunity zone. And that would be through like an LLC of some sort. And then, actually doing it yourself compared to having a fund manager do it for you.
Yes, and we do have experience helping clients back in the olden days.
Yep.
Yeah, so this is very good, I think. Opportunity zone, please do not overlook that, okay?
Yep, keep it on your radar. Again, nothing to do with that right now, but then as soon as July 1st opens up, you
I want to touch one more thing, Jacob. People do ask me, so how does it compare with 1031, right? So I give you a simple answer because we do have a time constraint here. So normally, if it's a long-term real estate investment, 1031 is still the best, right? These money going to opportunities, a lot of times people sell stocks or people flipping houses, right? Those are the best money to go into the short-term capital gain and other stock investment, because you cannot do a 1031 with a stock, right?
Yep.
But
yeah, I agree. So if you're one of those people who are shorting the stock market right now or something, and you made a couple $100,000, this would be something to possibly consider if it was 2027.
You're right. For long-term real estate investment, I still believe 1031 is better. Yeah. Go on to your next topic. Sorry, Jacob.
So next up, the next change is bonus depreciation, which I know a lot of you guys, especially the complex real estate investors, are very, very excited for this. They made it permanent, right, until the next tax law changes. But as of now, there's no sunset on this. It was used in the, again, Tax Cuts and Jobs Act, and it was starting to phase out. But now it's been brought back to that 100% bonus depreciation. So, Justine, what would you say? What assets could be bonus depreciated?
Yeah, that's another misconception. People, there are people think, oh, I buy $1 million property, now I'm gonna bonus depreciation, depreciate a whole million, right? It
Yeah.
doesn't work like that. So the definition is any depreciable assets that have less than 20 year of a depreciable years can be 100% bonus depreciated. So give you an example, it could be a car, right? I think a depreciable year on the car is what? Is less than 20 years, right?
Yeah, about
Or
five.
computer,
Yeah.
yeah, or computer, or I don't know, a kitchen. If you redo the kitchen, I think it's less than 20 years. So as long as the lifetime of the asset is less than 20 years, you can do that. So get to a real estate investor. If you buy a piece of property for $1 million, very likely, just roughly, you can probably write off 300 to 400,000. And let me break it down for you. So in the million, you always have a building and structure percentage, a building and the land percentage. So the land is not depreciable, guys, right? So we got to take that out. What's the percentage? We don't know. Normally on the West Coast, it's a very high percentage. So it's not very nice. But in the Midwest, the land is about 20%. So you will have an $800,000 depreciable assets from the million. And then in the $800,000, we can break it down to some like maybe $300,000. That's less than 20-year depreciable assets. That's when we can bonus depreciate it, right, Jacob?
Yep. Yep, exactly. And if you ever are unsure what assets are under 20 years life, the IRS has it clearly listed on their website if you want to do your own research. As a rule of thumb, I normally say anything that's not really attached to the structure or isn't structurally important, most of the time is under 20 years. But yeah, so it is listed on the IRS, or again, feel free to contact your accountant or us, and we can help you along with that.
Yeah.
And then again, the effective date for this is any asset acquired after January 19th, 2025.
Yeah, I have something to add on this point too. I had the client purchase a building in December 2024, but he placed in service March of 2025. Unfortunately, you cannot use the 100% bonus depreciation. You can only use, I think it was for 2025, it's 40%, right?
Yeah.
So you can still do the cost segregation, but the bonus depreciation was phased down to 40%. In 2026 now is 20%. So our president want to make sure we buy the property after he was after the inauguration day.
Yep, that's
Okay.
everybody's like, why is it January 19th? Because that's you had to put a stamp on it because when I got in office, right?
Yes. Okay. All right.
All right, now let's get talking to the meat of the conversation here, and it's how to leverage bonus depreciation. So, a couple ways to use 100% bonus depreciation right now. There's a passive income portion or an active income portion. Justine, do you want to talk about the passive income side a little bit?
Yeah, sure. So we talk about the law change, but I think the meat of presentation is how you can utilize it, right? So I think in my book of business, more than 50% of my clients are high W-2 earners, and they do real estate just on a passive basis. It means they don't really materially participate. They just have a tenant live there for, long-term tenant, right? So if you do long-term rental, or you just invest in other people's projects only. So for you, real estate is really a passive activity, right? So the bonus depreciation can still help you because some of my clients have such great returns on their investment. They have a few $100,000 net rental income, and they don't want to pay tax on that, right? I do have a client that's every year they're paying $50,000, $60,000 just on the rental income. And I told them, all you got to do is every year buy a new property and the bonus depreciate, and you can write all of them off and also expand your real estate, right? So now bonus depreciation can help you for these clients offset their net rental income.
And now
and Jacob, we're going to talk about the active.
yeah, let's get to the active now. This is where people really start getting exciting. And it's how to kind of turn your real estate investment into an active income and then active activity. A couple ways to do this. One is short-term rentals, and another is real estate professional status.
And the reason to go into active is what? So we can generate active loss.
Yep. Yep, exactly. So the whole
You
goal.
want to produce active income, but generate passive of active loss on your tax return.
Yep. Yeah, exactly, and that's why it works out so well for maybe some very high W-2 earners or people with very strong business income or anything like that. That's when you want to convert that activity to active by following the rules, which we'll get to shortly. But convert that activity to active so that you can take the active losses against your income. So, how do you make this activity active? And there's the material participation rules. So you have to materially participate in the property. For the short-term side, one way to do that would be spend 100 hours or more managing the property and spend more time on it than anybody else. So we normally say this route is great for people without property managers who are doing it all themselves. Or I have seen, some clients reach out to their property managers to see exactly how long they are working on the property and putting in more time with that. But if you want to be on the safer side, I would say, and this is what we would normally recommend if you do have a manager, you'd want to do 500 hours. Or, and even easier to get that 500 hours, is to group your rental activities. So if you have multiple properties, you could group the activity, and then just put in more than 500 hours managing. And then you can also have property managers to assist you in those types of things. And that would meet the material participation rules.
Gotcha.
So now let's kind of go into what counts as hours. This is a question that we get a lot.
Yeah.
So Justine, do you want to take this?
I guess the most important thing to understand is like you really have to log your hours and don't be like, oh yeah, no problem. So if they do audit you, then you're not gonna have that log, and it's very hard to go back and reconstruct what you did, right? So it's very good to count only the actively participating hours in the real estate. Jacob did a good job. I don't think I want to like bore you, right? So you have to actually do the management, like talk to tenants, screen the tenants, talk to contractors, instead of say, hey, I spent 100 hours studying real estate. You think the IS is going to buy that? I mean, you might really have done that, but they're not going to buy that, right? Because people can cheat on that. But, you talk to the contractor for 2 hours regarding some issue. That's for real. We all know how long it takes to talk to contractors, right? So yeah. Jacob has a really good slide here. So all these real meaningful work you do managing your property, you got to get your hands dirty, okay?
Yep.
And that counted. And yeah.
We're obviously not going to read this word for word. But yeah, all work done and active in the activities operations. One question I do get a lot as well is, me and my spouse do it together. How do we do hours? Does one of us have to put in the 100 hours, or could it be conjoined? It's conjoined. So, track your hours together. And then another thing is working in the capacity of an owner.
Yeah. So just really the real hours you spend, and a lot of people tell me, how do I know? I start logging, and then you will, by the middle of the year, some people say, oh, I made it. Yeah. And some people at the end of the year, oh, I didn't spend any time. Then, hey, you can't do this, right? You gotta really do this to be active. Yeah.
Mm-hmm. Yeah. And it's not the end of the world if you don't spend a bunch of time on it, because then you got a good investment that you're not spending much time, and it's truly passive income, right? So, yes. So it's never too bad to hear from a client and say like, oh, I didn't hit the 100 hours. All right, great. I didn't hit the 500 hours. All right, great. Then you just have a nice passive investment that's cash flowing well and tax advantage. So now let's kind of go into what a short-term rental is. Justine, what would you say is more common, this top one or the bottom?
The top one, yeah. I have very few people actually really. The bottom one is a hotel, isn't it?
Yeah. Or if you do have an Airbnb and you live in the Airbnb as well, and you run the bed and breakfast.
Bed.
That'd be very similar. Not many of our clients are doing that type of stuff. They don't want to be making beds, cooking meals. But hey, it is an option. Most people do go for that, keeping the average stay less than 7 days route. And that's actually not all too hard to do. I know that like Airbnb, VRBO, those types of services, you can limit the maximum stay. So, to be safe, a lot of clients will just limit it to 7 days maximum.
Yeah, and also it's average stay, right? You have some people only stay for 2 days, so now you can have the next person stay for 12 days or something
Yeah.
like that, right? Yeah. So
Yeah.
yeah, it's manageable as long like Jacob said, you are on Airbnb and stuff, you're fine. But if you're renting it to a traveling nurse, then might be an issue because they normally rent for 3 months or 4 months. Then it's very hard to bring the average down.
Yeah. Yeah, but again, it is average. So, you get a couple of those 1 or 2 day rentals in there. And then you might have a guest staying for a 7 day stay and they ask to extend a little bit. I obviously wouldn't tell them no. I would say,
yeah,
you check your numbers, make sure you're keeping it under 7 days. This is a strategy they're going after. And, you can't have a couple people staying, more than that 7 days as long as that.
Yeah. And
less.
another thing I always say is it's for us to tell you what is a short-term rental. Doesn't mean you just try to squeeze your property into this, category, right? If your property is not really this category, it's okay. There are other tax strategies. But if it is, let's use that short-term rental loophole, right? Jacob is going to talk about. Yeah. Mm-hmm.
Yeah, I always say never do anything strictly for tax. To report a huge loss if your rental's not doing well. Like, yeah, I'll save you tax dollars, but you are losing money. So you do want to make sure it's a sound investment, and then use these strategies for extra benefit. Then.
Mm-hmm. Yeah, agreed, totally.
So next up is rep status. That's real estate professional status. This is an exciting one too. The main rules on it are you have to spend 750 hours in real estate activities or more a year, and this is all yearly, and then you are doing that more than any other activity. So with that, you might be thinking, how can I be, some of our clients, how can I be in the top tax bracket, making very high W-2 income and say that, I'm a real estate professional? What's your response to that, Justine?
That's always the joke, right? Doctor marries a real estate professional. So if you're married, your spouse can probably help you. Or if your spouse is not happy with their work, maybe quitting the job and become a real estate professional is a way to go. But like Jacob said, just don't do it for that reason. If your spouse loves real estate and you guys want to build your real estate empire, please use this code. 750 hours is not hard. But if you have a full-time job, it's almost impossible because a full-time job is considered as a 2,000-hour job. Even if you're very smart, only work 2 hours a day, it's still considered 2,000 hours. And then I want to go up a little bit. So how to create active losses? There's two ways. One is going through the STR and the material participation. One is through this rep. So you don't have to do both. It's either or.
Yep.
Right? If you're reps, you don't have to meet the STR requirements. Okay.
Yeah, so exactly, that perfect marriage is, that doctor, that attorney, that business owner, and a real estate professional. It really unlocks a lot of tax planning strategies that can be done. So next up, it's how to use 100% bonus depreciation. So once you have that short-term rental, or once you have that real estate professional status, how would we use it, Justine?
You buy the real estate, do a cost segregation, and go to an attorney, go to a CPA that knows how to get your bonus depreciation to offset your W-2 income, right?
Yep.
That's the three steps. You're missing one. You need a CPA there.
Oh, yeah. And we'll add something to the slide there. And I definitely say if you're doing any of these plays, make sure that you are using a real estate specific CPA firm who knows what they're doing. I have seen horror stories where, one box isn't checked correctly and, something like that would mess it up. So just go with somebody who is confident in reporting these. If it is a short-term rental, if it's the real estate professional status, whatever it is, just, go to somebody who knows what they're talking about. Don't try to do it yourself on TurboTax. I can definitely say that. Or another way is, like, let's say you have a short-term rental that you purchased in 2023 You already did a cost seg on it, or 2022, got your bonus depreciation from the purchase. What you can do there is purchase new assets, improve the property, you know.
Yes, improvements also consider. You're right, improvements.
Yeah, yeah. So you want to put on an addition, great. You know that could some of that could be bonus depreciable property. You want to refurnish the property. Yeah, your couches, that's going to be bonus depreciation. Your new kitchen sink, that's going to be bonus depreciation. So don't think that you have to go out and buy a new property, um, but it's oftentimes you'll get more benefit with buying a new property just because there's so much assets that you can bonus
Mm-hmm.
depreciate.
Yeah. I think I want to, again, just say one thing from all the questions I get. People always think cost segregation and bonus depreciation is one thing. So it's just two different concepts. Cost segregation is a study done by an engineering firm to tell the government or stand by their report, like this piece of real estate, what's the amount of, is the property that's 5-year property, what's 7-year, what's 15-year, what's 39-year, what's 27.5-year, very detailed. And this is the report as a CPA we need to use as a basis to take the bonus depreciation. And to take the bonus depreciation also doesn't mean you can save tax right away. You also have to meet the other two criteria that Jacob talked about, the short-term rental or the reps. Then you can use that phantom expense to offset your W-2 income. Otherwise, you can only use it to offset other rental income, right? I just want to say it one more time because there's a lot of things going on the internet. Just put all these concepts together. Everyone's like, so what is this? What's that? I just want that everyone that's attending this webinar walk away very clear what is going on.
Yeah. Yeah, too many people right now watching TikToks and those types of things, only getting a 5-10 second video. You can't get the whole story that way. So yeah, I'm happy you guys came here so we can really break down the difference here.
Yeah.
So next up is, should I get a cost seg? And this is a question that we get a lot of times, right? So Justine, in your opinion, who should get a cost seg? When should you get a cost seg, and why?
So if you can meet one of the two criteria Jacob just talked about, material participating in STR, or you are a RAPS, then why should you not? You definitely should get one. For people who are not in those buckets, who real estate is truly a passive activity for them, there is a question mark. Should I get it? There is two different thoughts. One is, I'm still gonna get it. I'm gonna get so much depreciation this year, even if I cannot use to offset my W-2 income, I'm gonna use it to offset all my rental income. And even if I don't have a lot of rental income this year, I may have it next year. So I'm just gonna do it. I will never say no to those people, right? It's fine. And the other school of thought is, if I manage my real estate portfolio well, I should never see taxable rental income, even with regular depreciation. This is a little bit harder, like a deep topic. So I think a cost seg costs you about 2,000 to 3,000. If that means nothing to you, like, oh, that's not even money, then just do it. It's not going to hurt you. But if you think that's still money I don't want to spend, I want to make sure it's going to bring me big refund, then talk to your accountant first.
Yep. And then when we get into it, our questions are like, do you have active income to go against this, especially if you're going to short term or rep status? Like, do you have active income? And then what tax bracket you're in as well. Sometimes it doesn't make sense for somebody who's making 50 grand a year to do a cost seg on a property. With the standard deduction, if they're in the 10% tax bracket, your savings on that bonus isn't not going to be much. If you're in the 37% tax bracket, just about every time it is. Let's get this done. Right?
Yeah.
Now, this is a big question we get too. Will this raise audit risk? Justine?
Oh yeah, if you're making $1 million W-2 and you have like a $500,000 loss on line 8 of your tax return, very likely you will. But we always tell clients, so even if yes, we still do it, right?
Yeah. So, and again, this goes back to going to a firm that really knows what they're doing, because it will raise audit risk. But that's nothing to be scared about, right? Why? Because you got to be prepared for it. You got to do good records. So keep good records, revenue, expenses, those types of things. Have good guidance and keep good books.
Yep. I mean, easy said than done.
Yeah. Yeah. I mean, it's easy for us to say it, but
Yeah, most of the investors hate bookkeeping.
yeah. Yeah, but I mean, if you're making it active and you're with that real estate professional status, or you're doing a short-term rental, you maybe pay your kids to do the books. This is something that you're making too much money, you don't have time for that. Your kids might have time. You might have an aunt, a grandma, and that will be a business expense as well. So it's definitely important to keep good records. Or you could pay somebody like us to do your bookkeeping, anything like that, right? So
Yeah,
here's
we
some
do. We do
guidelines.
help some. We
Oh
do
yeah.
help some realtors, real estate investors. Yeah.
Oh yeah,
Mhm.
yeah, and happy to do so, of course, as well. So now let's kind of get to the guidelines for good record keeping and how to kind of prepare. So first thing, track your hours. As Justine already said, you don't want to be going back at the end of the year, 2 years down the line, where the IRS can audit you for 7 years. You don't want to be going back 7 years down the line trying to piece together your hours on what you
Yeah.
spent time on based off of emails or your calendar.
Yeah.
That's not good. So
Yeah.
actively,
Jacob, I have to say something. We only have 10 minutes left, so we do have
oh,
a lot of slides to go through. So I feel like everyone who's attending this will get the PPTs and the recording, right? So I'm not saying that you should, I think we should speed up a bit.
all right, got it. Speed up. So how to track hours? Most common people just use Excel. There is apps like Reps Tracker that you can just click in, click out. Those are nice and easy.
Yeah.
Now, bookkeeping rules. Justine, you want to take this one?
Yeah, I always say first you make it easy for you. Don't just, oh, I'm going to use my own credit card to get points. Forget that, okay? So whenever you have a business in general, you always have everything separate. That's first thing. And if you have multiple properties, should you separate every property into a different account? Now that's a little bit too much, I think. But if you have 50 properties, maybe you should still do it. But my thing is separate your spending first, business credit card, business account. So it's easier for you to track whether this is actually making money for you. And it's easier when the audit comes, right?
Yeah.
So you guys all see Jacob's 7 year. Make sure keep your receipt 7 years. Electronic is fine. Doesn't have to be paper record, right?
Yeah. Now it's nice and easy. A lot of things get emailed. So just have a nice little folder in your email box where you just drag your
Yeah,
receipt.
and most of my clients should have an LLC for their real estate investment anyways. So, right,
Yeah.
should have a separate business account.
Exactly. And if you don't, if you're just keeping it under your personal name, it is worth opening just a separate account for tracking purposes for
You're
yourself.
right.
Helps with sanity, right?
Yeah, yeah.
So let's get into bookkeeping system recommendations. Definitely recommend starting with Excel. No point in adding costs to yourself. If you can manage in Excel, at some point, let's say you got 1, 2, 3, 5, 10 properties, Excel just becomes unmanageable. Can't do it. Switch up to like a QuickBooks software, something off the shelf, nice and easy. I believe that it's the subscription cost isn't all too much, so definitely worth looking at that. Then after that, let's say QuickBooks isn't doing it for you anymore. You don't like the way the QuickBooks works. There's like CRM systems. If you have a bunch of properties, there's other rental bookkeeping options. Happy to discuss any of those with you guys. But most people are working Excel, QuickBooks, CRM's more once you start getting 50, 100 properties in there.
Yeah. We're spending this time with you guys talking about the bookkeeping is not to bore you guys because this is the foundation of you so you can of your business so you can take advantage of an advantageous tax code.
Yep.
This is very important. If you have this, then you don't worry. Mm-hmm.
Yep. And this is that's what we want to drill in is be prepared. Have your ducks in a row. All right, now this is the fun part again. How to lower taxes through bonus depreciation.
Okay.
Justine,
you gotta do an example, Jacob. Oh, you want me to? I did the example earlier, but you can do this example.
All right, perfect. So we have a you're making $1 million via W-2. You purchase a short-term rental for $1 million. You get a cost seg done. You're looking at about $250,000 of deductions or bonus depreciable assets. So that will create a rental loss of $250,000, assuming a tax bracket ratio of about 40%, including state and federal. You're talking tax savings of 100 grand.
Yeah,
And
and
why is
some
that so magical?
yeah, and also I have to remember the $1 million STR purchase, you don't have to spend $1 million, right? Most people put about 30% down on an investment property. So with a $300,000 purchase, you're getting $100,000 back. And if you live in California and New York, you are going to get like $150,000 back.
Yeah.
Yeah.
Yeah,
So
these
the
are
Uncle Sam just funded your half of your real estate adventure.
yeah. Yeah, this is and these are conservative numbers here too. Sometimes it's higher. So yeah, a lot of times Uncle Sam is funding your rental purchase or a large portion of it.
Yeah. And we did a webinar before with a doctor, and they've been purchasing one or two every year since 2018. And every year they get a 6-digit tax refund to fund their next project. It's a real story. Like they probably own 10 properties by today.
Yeah, yeah, it's recyclable, and then by the time they hit retirement, they're on just cruise control, right?
I do have a question people ask me. So you take all your bonus depreciation, then what? Then you have no more depreciation. So first of all, you keep buying, but you can't keep buying, right? After 10, 20, you might not want to do it. What you can do is you can 1031 exchange to other things. I think we're going to talk about this later, right? So there is always a way, and you should not recapture those depreciation. Then if you do, then you're not doing a good planning with your accountants.
Yeah, exactly. So really quick, we'll hit entity structure. Again, we said that having an LLC is great. If you set up an LLC to do single member, especially for your first property, even if it is jointly owned by you and your spouse, this cuts down on the need for separate returns and stuff like that. If you are doing an LLC and let's say you're partnering with your brother, you're partnering with a random, I mean, not a random person on the street, but one of your friends or something, you could do a multi-member LLC and it'd be taxed as a partnership. So yeah, that's great for multiple families on a single property. If you really want to get complex with it, you can create a holding company up top. So how it would work would be, you own most of the time a living trust or directly into the holding company, and then the holding company owns separate property-specific LLCs.
Yeah. So
If
two things I want to add on. One is making sure the holding company is owned by your trust, so it doesn't go to probate court if something happened to you. The second thing is making sure never ever use S corp as the business to own a rental property.
Yeah, yes, to stay away from the S corps. I know I get that questions a lot. Without getting too complex here, yes, just stay away from the S corps for the holding. There are some alternatives too, especially with your first property. You're not sure if you want to go through with an LLC and that type of stuff. I do see some clients use an umbrella insurance policy to help limit some of that risk as well.
Yeah.
But with a short-term property, I would definitely recommend some sort of LLC structure because you got people going in and out, so many different people. A lot of times people are partying in these short-term rentals, especially if it's on a beach, or in a city. So it's great to have a little bit of legal protection there.
Mm-hmm.
So now, how do we convert these into tax-free real estate gains over a lifetime? Or basically, how to never pay taxes on your real estate?
That's a big topic.
Yeah.
We leave it at last.
Yeah, and it seems far-fetched. How can that be done? How can I build all these assets? It is possible through planning and strategy. Normally, rentals are showing tax-free cash flow, just with the phantom expenses of the depreciation and everything like that. The cash flow most of the time comes out tax-free. And then we did talk about 1031 exchanges. When you are ready to exit your investment, don't just sell because there's depreciation recapture. There is capital gains associated.
Mm-hmm.
Yep. You can go for a 1031 exchange and exchange it into a like-kind property. Sometimes a trip up there, like-kind, it's like, oh, do I have to buy another apartment building or do I have to buy another condo? No, as long as it's rental real estate, it is like-kind. And then, you continue doing that out through, throughout your lifetime. Upon death, when you, transfer it to your heirs, they receive a step-up in basis. So, Justine, what does that mean?
Again, capital gain is forgiven,
Yep.
all of it. And the depreciation recapture is done. It's scratched off.
Yep.
Yeah.
And then, as you grow, you might be getting close to that estate tax amount. So you got to estate plan properly too. Let's say you have a bunch of properties, you're probably going to be looking at possible estate taxes. So yeah, just estate plan properly with a good professional.
Yeah, I always say this for real estate. That's how it works. Yeah. So, anyways, well, we have a slide. Wow, that's a nice one about 1031. Yeah.
Yeah.
We do have a nice podcast that's coming out. Jacob and I did a really deep dive into 1031. There's so much misconception. A lot of people don't do it because they think it's too hard, it's impossible. But in my 30 some years of practice, I've seen so many successful and creative 1031s. I think the main point here, we're probably not going to read this, is to talk to your accountant before you sell. Not call me, Justine, I have a closing tomorrow. Can I do a 1031? Don't do that. You really have to look at the strategy, your replacement property, way before you even list the property to sell. And if you do that, you should be able to successfully do 1031 again and again and achieve the previous slide. Jacob said, never pay tax.
Yep. So like the main things you want to hit here is qualified intermediary. They want to have that set up. You can't have the funds hit your personal account at all. I would say that's the biggest thing that you got to really be prepared for. And then, beautiful slides so you guys can read that. And I'm sure we're sending it out afterwards as well.
Yeah.
So here is the logical steps for real estate investment. Just getting started off, maybe start with a short-term rental to make it active. Hit that 100 hours, get your feet wet. You already have a couple short-term rentals or one, start picking up some long-term rentals. Start looking into that real estate professional status. And then once you're a little bit more complex, a little typo in here, I believe proper just. We got, next step would be possibly commercial properties. These are more for advanced real estate investors. After that is
you get a higher return on that. Yeah.
Yeah. After that is triple net properties. These are very passive. I'm not sure if many of you know exactly what a triple net is. Triple net is where the tenant will pay for the property taxes, expenses, repairs, and all you do is collect a rent check. Those are great. The tenants are normally like you want to look for like a Starbucks, a strong corporate tenant with a very long lease. And then once you want to completely have no management in real estate anymore, look into a DST. It's called the Delaware Statutory Trust. It's a trust setup created by some complex, very smart accountants in Delaware, and it allows you to 1031 into those as well.
And you really don't do anything but collect check in the mail.
Yep.
And not pay tax.
And after that, all you have to do is die and have your kids or your heirs inherit everything tax-free.
I don't want to die. Okay.
All right. Well, so that kind of wraps everything up.
Yeah, we have all the we covered a lot of things. Jake was really good preparation on this. Like I said, we had a lot of webinars on specific topics. We also started a podcast last year. So I think most people are very, very busy. But when you walk your dog or just take a walk, listen to these. I think we try to make all our webinars and podcasts to be very educational, and hopefully you can learn from it. I do believe as clients, you need to know enough to know that your accountants are doing a good job, to know what questions to ask, right? Yeah. To make an educated decision.
Yeah, so we have some longer form YouTube videos out there and also some shorter form YouTube videos. Spotify is a good place to find our podcast. And then I do believe we have some sort of Facebook presence as well.
Mm-hmm. Good.
Yep. So next up, if you'd like to schedule a 15-minute consultation with either me or Justine, our scheduling link is right here. Completely free of costs for that first one to see if we're a good fit and everything. And I know a lot of information came out today that we've given you, so you might have some questions on them. So feel free to scan and schedule with me or Justine.
Yeah. So just one disclaimer, if you're an existing client, you really should not do this. You can always reach us already. These are really for people who are not our clients yet and want to know more about us. And I believe Jacob has more availability and he knows a lot. So schedule with him first.
Yeah, and again, those existing clients, just send us an email if you want to chat. We're always
Yeah. You already have our contact information,
yeah.
right? We're always here to help you. Yeah. Okay. I think we have about 10 minutes left. We're gonna hope we have some good questions, Christy.
Yeah, we do have a fair amount of questions. I will just start with some representative ones. So first, actually, a couple of people both asked this question. They're asking like, where can I find those investments map starting July 31st, 2026?
All that, I'm sure on August 1st, if you Google search, it's gonna come out. Hopefully it's come out on time. So Opportunity Zone, there is a government website.
Yep, exactly. And I'm sure I'll be in the news as well. I don't think the IRS has offered much guidance on the new qualified opportunity zones yet. So I'm sure guidance will come in months.
Yeah, but you can also just go online now, look for the old map. It's a map.
Okay. So next two questions are from Ozzy. So he's asking, first of all, like when we file this year, what information do taxpayers need to provide a company like us, a tax firm, Zhou Agency, to take advantage of bonus depreciation? And he also is asking us to recommend a real estate accountant.
Ozzy, I'm your accountant. You're okay. I'm
well, I
crying.
don't know. I mean, his last name is Fuentes. Maybe.
Oh, then it's not. I'm sorry. I have a couple of Aussies. So this is not that Aussie. Yeah. So just for you, please schedule time with Jacob. We can. We disclaimer. We don't do cost segregation, and we don't have affiliation. But we do have a couple of companies we can recommend you because our clients have used them, came to us with high remarks, so we can connect you with them. And the first question, very good question, because we're very real estate centric. So every client come in, we will always look at, should we do the bonus depreciation? So if you come to us in March, we look at it, we say you should do a cost segregation, and really you can save so much tax. We'll do a projection for you, and then we'll say, hey, we will file an extension for you. You go do your cost seg, and we will finish your return in the summer and get a huge refund. So this is not something we might look at it. We definitely look at it. So no worries, Ozzy. Yep. And the scheduled time was Jacob to talk about details.
Yeah, and one common misconception here too is like, oh, I need to get the cost seg done in the year I purchased the property. No, that's not true. You just have to get the cost seg done by the tax filing and have it to us so that we can record it.
Yeah, and tax filing deadline can be extended, guys. So we're talking about 10, 15, 2026, 4, 2025, right?
Yeah, and if you're getting a refund too, you don't even have to file by that 10-15 deadline as well. So, just we'll talk with you the first time and see if it's worthwhile, and then we'll just have to wait for that cost seg to come in.
Okay. Ken Chapman is also asking, how do you charge?
That's very sensitive, right?
I think that's
I'm kidding. I hope we can charge by percentage, but that's not very ethical. We don't do that for the refund our clients are getting. No, we have a pricing mechanism. So everyone's tax return is very, very different. We sometimes spend 5 hours on one return and 50 hours on another return. So there's no way we're going to charge the same. So there is a pricing mechanism behind it. So the forms we file and the time we spend with you, so it's all together combined. The system will generate a price. And for any new client, it's very important, talk to us first, submit us the last year return and tell us what happened this year. We will give you an estimate so you don't come in blindly.
Yep. It's based on forms and complexity. And I have definitely heard, a lot of new clients are amazed with, the work that we do and the prices that we charge. So yeah.
Okay, last question probably for bonus depreciation.
Okay.
From Deep, so he's asking, if I move an asset from personal ownership to owned by an LLC, and that LLC is actually owned by him as well, does that count as a place in service and qualify for bonus depreciation?
Not exactly. Very smart thought, right? So to qualify for bonus depreciation, for any depreciation, this has to be a business asset. So you have to use it in the business. So we are talking here the business rental business, right? It could be a manufacturing, it could be anything. So just transfer the title from your personal name to an LLC name, but you're not doing anything with it. Your LLC is not doing business, and the LLC is not using the asset to make income. No.
Yeah, so the key here is the property is placed in service when you have renters in it.
Yeah, yeah, yeah. And sometimes if you buy the property, let's say in 2024, and you rent it out in 2024, but you just put it in the LLC today, that doesn't change anything. It was placed in service already in 2024. So it's more the substance than the face. Mm-hmm.
Yep.
Okay, so next are about cost seg. So Matthew is asking whether a 24 bracket tax bracket makes sense for cost seg, and Marley is asking whether are there any better cost seg companies than other companies?
Okay, so Molly, again, you can schedule a time with Jacob, or you can just email. We have our email here, right? You can just email us if all you want is a cost seg company. We will try to connect you, right? The first question was good. Is 24%, should you do it? So if you're 37%, definitely. 24% is kind of on the fence a little bit, but 24% is still quite a bit of money, right? And depending on what's your income in the future too, is your tax bracket is going to go up, and do you have state tax? Does your state also allow bonus depreciation? All these has to be factored in. And also another very important thing is, where you are, in your life, and what do you want to do? What's your goals and objectives? All these has to be considered together to see whether it's worth it. For me, if you can do a $3,000 cost seg study and get $100,000 bonus depreciation and save $24,000 tax, it's a good deal.
Yeah. Yeah, you gotta look at your ROI, and we're happy to have those conversations. We can basically, we've done it so many times that we can ballpark it off the top of our head based on your, the information you give us. So it's a quick conversation where we can kind of judge if it's worthwhile or not. And then for the cost seg companies themselves, I would say, it doesn't matter which cost seg company you go with. They're all certified to do it. So it basically comes down to who is the most responsive and willing to work with you, and the cheapest price is what I'd say.
I actually had a client that did an Excel with four different cost seg companies. He talked to very, very, very engineer, very cool guy. So at the end, I think you're right. First, you have to make sure they're audit proof, right? They give you audit proof. That's very important. And second is their reputation and their experience. And third is their pricing. And I wouldn't necessarily get the cheapest, but compare all three and find the most economical one.
Yeah. And most of them will give you an estimate before even going in of what they expect to see come off on a cost seg and those types of things. Also, do take it with a grain of salt, because some of these guys are salesmen and they might inflate those numbers a little bit, or they'll give you a range. So yeah, just if you have any questions, we're always happy to chat about any of it.
Okay.
Yeah, we actually worked with one cost seg company that if you reach out to me, I'll let you know. They're very good. They send a report, and actually they changed the report later because there was some misunderstanding on the improvements and stuff. So like Jacob said, that the after sales service is very, very important. So don't just look for the cheapest price. That's it.
I do have another. I think this is a good question, because I even seen this a lot.
Okay, go ahead. We can stay a little longer. I'm just gonna pay Jacob some overtime.
So yeah, it's awesome. He has lots of good questions. I just select a couple. So he's asking, what are the tax benefits of creating a holding company versus individual LLCs?
So you're not creating tax benefit by doing that. You're creating the two levels for two reasons. One is just how I say it. You have two layers of protection, right? And also filing is so much easier. Just say if you have a parent company, so the parent company may be owned by your trust, your sister's trust, whatever. Like you guys have a couple partners, and then this parent company will own each individual properties as a single member LLC. So these property specific LLC does not have to file a separate tax return. So you might own 10 properties, you only have to file one tax return. So it's just ease of management and double protection.
Yep. Yeah, and a lot of time the holding companies are set up in a more business friendly state as well. So, get a little bit more protection.
Yeah, that's anonymity, right? If let's say you're in the state of Illinois, you set up an LLC, everyone knows who set it up. But if you go to state of Delaware, nobody knows who that is. And if you're a famous person, you don't want people to know.
Exactly. All right. Do we have any other questions that we need to hit, Christy?
But I think it's fine. Yeah, because our time is up already anyway.
Yeah. So schedule the call with Jacob, and then when you get the recording, send to friends and families who might be interested. We are really happy that you spent this hour with us, and Jacob did a good job.
Yeah. Oh, thank you. And you too, Justine. I actually have my calendar open next to me, and I do see people are already scheduling. So we must have done all right. Appreciate all you guys coming, and look forward to seeing you.
Let's
soon.
take some money from Uncle Sam and build our real estate portfolio. How about that?
Yeah, exactly.
Bye, everyone.
Bye.